All right, so let's look at a comparison between the expenditure approach and the income approach. We can kind of see the different um, percentages here. Okay, so again, looking at the expenditure approach, consumption from the household sector is the biggest part of our economy, right? Almost 70% of GDP comes from consumption from households. The next biggest chunk is business investment at almost 18%. And then not far behind that is government expenditures at almost 17%. And then the interesting thing here is that foreign expenditure is negative 2.9%. Okay, so basically what that means is that we buy more stuff from foreign countries than foreign countries buy from us. So in other words, what we import from other countries is more valuable than what we export to other countries. So the net exports part of our GDP is actually negative. All right, and then looking at the income approach, we see that wages accounts for the majority of the income approach, over 50% at 55%. The next biggest chunk of the income approach is profits and non-income expenses. So those indirect business taxes and depreciation, almost 40%. Rent is the next biggest chunk of the income approach at 4%. Surprisingly small, actually. I would have expected that, I would have expected that to be bigger as an undergraduate. And then interest is the smallest chunk at just over 2.5%. And then here we can look at a comparison side by side of the two different approaches. These are the actual figures for the year 2017. So starting with the left side and the expenditure approach, we've got $13.2 billion in consumption expenditures. We've got $3.2 billion in government expenditures. We've got $3.4 billion in business investment, including depreciation. So that's gross investment. So including expenditures on repairing old buildings and old machinery. And then the last one, net exports, again, is negative because we are importing more than we are exporting, right? So we're buying more stuff from other countries than other countries are buying from us. And so net exports is negative. All right, so that all comes out to a total of $19.3 billion. I'm sorry, I misspoke. These dollar amounts are in billions, which means all of those figures were actually in trillions. My mistake. So 13.2 trillion in consumption, 3.2 trillion in government expenditures, 3.4 trillion in business investment, and about $500 billion negative in terms of imports versus exports. All right, and then let's look at the income side. So again, the biggest one on the income approach is wages. So salaries, supplemental employment compensation, hourly wages, all of those things added together accounted for over $10 trillion. Okay, so that's pretty huge. Rent was only $773 billion, or 0.7 trillion. Interest was around half of $1 trillion, or 500 billion. And then we've got the profits and non-income expense items last year. So proprietorial income, or in other words, profit, is $1.5 trillion worth of the economy. Corporations' profits before taxes were deducted was $2.1 trillion. And then those non-income expense items, so indirect business taxes and depreciation, accounted for almost $4 trillion. And then there's that statistical discrepancy I told you about. So just in calculating all of these income measures, there's going to be a statistical error, basically. And so that's what that statistical discrepancy is. But in any case, these two numbers have to be the same, right? It's an accounting identity. And so that's why we have to adjust by negative $21 billion, given the statistical discrepancy, so that the expenditure approach gives us the same number as the income approach.